The Taiwan index managing to hold on to some bit of a gain of almost 0.04%.
TCS was a muted set of numbers. HCL Tech was strong. And now all eyes are going to be on Infosys.
Stuck in this range, 24,900 on the downside we saw yesterday and 25,230 on the upside.
The other one I'm looking at is from the metals pack, that is Nalco.
Trust board will need to decide who the new nominee will be.
0.25% higher, 25,030. And the Bank Nifty starting absolutely flat.
Clearly think at this stage, I think the large caps are a big avoid.
Domestic revenue at its highest and LATAM breaking its own record.
The benchmark indices are nearly down 1%. The Nifty Auto Index is down 3%.
899 odd crores is where they've come in at. So that's a growth which is above what the street was anticipating. It's a down day despite the handover that we got from Wall Street.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, it is a red day, and it has been that way, as you can see from the preview that we played out and in terms of how the day is played out. 200-point cut. I mean, this is, I think, larger than anybody would have thought when we were kicking off trade this morning. Handover was positive from Wall Street, but none of that has mattered today. This is Closing Bell, last hour coming up. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi. Afternoon.
Hi, afternoon. It's all in the red except the IT index. That's the only one up nearly 1%.
Well, not a great day, right? If you're looking at the sports section or you're looking at the markets as well. In sports section, New Zealand and India batted first, 46 runs all out. And the last time I checked, New Zealand has hit 50 runs, no wickets down. So it's that sort of a day, and it's a 5-day test match. So hopefully we bounce back from there in the next 5 days. And the Indian markets, well, we're down today, but hopefully we protect the recent lows and bounce back from there.
But it's kind of not confounding, but maybe a little offside, right? Because there was no indication that we'd have a 200-point down day. At least from the regular indicators that you look at, which is, how the US is shot, or how Asia was trading, or, if something had happened on oil or something, nothing. It was, that was all kind of all clear. The index had been ranged, but it was ranged between 24,900 to about 25,230 or so on the higher side. But that range is broken. It's gone. And we are now on the Nifty bank, sharply below where we were yesterday. I mean, actually, yesterday's low was 24,900. Now we're about 150 points under that level. So what's going on? I think that's the question. One sort of new thing in that sense, which has entered the lexicon of many who have come on and who we've spoken otherwise as well, that maybe people are starting to acknowledge that some of the high frequency indicators are slowing down. I mean, so I saw a Morgan report. There was something from Nomura earlier. Bernstein, for example, had put out something, and this is something which people are starting to acknowledge that maybe it may be cyclical, but at the margin, are we sort of entering a phase of a slight slowdown? And I think this stands out sharply because we are in the festive season, right? And things like two-wheeler sales, Bajaj saying that, well, sales have only grown 5%. I think actually for the festive period, they said, well, sales have only grown between 1% and 2%. For the entire festive period, they're saying, sales are expected to be up 5%. I think it's things like that which at the margin are hurting what has anyway been a slightly ranged and sluggish kind of index out there. Advanced decline, of course, negative. We'll talk more about individual names as we go along. Reema.
Even Nestle's commentary and numbers point to a softer consumer demand.
Yeah.
So Nestle's stock is down 3.5%, reacting to Q2 numbers. The company's domestic revenue growth was just 1.3%. The street was anticipating mid-single-digit revenue growth. They said key brands have witnessed pressure, and even margins for the company fell by 360 basis points year on year, coming in lower than expectations. So consumer demand is soft, whether it's Bajaj Auto and the kind of what they had to say about festive demand, or even from Nestle India. So that's the sentiment. But outside of that, you are seeing cuts in Shriram Finance. In fact, the entire auto pack is weak in trade. M&M, Hero MotoCorp, Maruti Suzuki, HDFC Bank, which was holding out one end of the market for the last few days, today has come under pressure. That's down close to about 1.25%. On the way up, well, it's only IT, right?
Yeah.
And IT is looking quite good. Nifty IT index is up 1%. Tech Mahindra, Infosys, Wipro, these stocks are leading.
Well, I'll want to see what Infosys does, Reema, tomorrow, because we'll get the numbers and the guidance today. But the kind of build-up you've seen in the F&O market, the kind of cash market delivery as well, it'll really have to be a blockbuster with very, very good guidance if the stock needs to sustain at these levels. It's at a fresh all-time high. Infosys, just I think at around 1 p.m. it hit those all-time highs of 1,985 odd. But it's come off a little bit. We're talking about Infosys, so I think we should get that stock up for you on the screen. Well, how should you position yourself, though, in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, you've been sounding a little bit cautious about the markets, and that call is proving very, very right. What do you do now? We've got a drop of close to 600 points on the Nifty Bank, trading below the 100 and the 50 DMA. And on the Nifty as well, we're very close to the recent lows. What do you do?
Ajal, we've kind of met the target which I was looking at, which was about 24,800, 750. The worry now comes in if we start breaking below that, and that also looks like a good possibility to me. So I would now look at a test of 24,350, 370 zones. I hope that level sustains. For the time being, this level hasn't broken down decisively as yet. We are just about 5-10 points below that, happening around that level, but the structure remains weak. So it will be a good idea, if you can have some put options or a put spread where you buy a 24,700 put and sell a 24,400, 350 put, on the Nifty. That could be a decent trade. And on the stock side, I have one buy and one sell. Technology is looking strong, so that's a buy there. And Glenmark is coming under pressure. So a sell on Glenmark with a stop at about 1,762 and a target of around 1,700 can be looked at, maybe below that. And Tech Mahindra is on the buying list, which I would recommend buying with a stop at about 1,680 and a target of 1,750.
Thank you very much for that. Glenmark Pharma and Tech Mahindra are Mitesh's picks. Let's talk about the sector of the day, auto, the stock of the day. That's Bajaj Auto. Massive, massive fall. I think this is the biggest fall they've seen since March of 2020. Q2 numbers were largely in line, but it's the commentary about the festive demand that's hurting sentiment. Sudarshan joins in with the details. Sudarshan.
So Bajaj Auto today has faced a sharp 12% drop in its stock price, the largest decline since the COVID market crash that we saw in 2020. And this sharp fall is after Bajaj Auto's earnings for Q2 FY25. And those earnings were in line. What has surprised the market is commentary related to festive demand. But first, let's look at stock performance this year. Amongst all the auto companies, Bajaj Auto has been one of the biggest outperformers. In 2024 so far, the stock is up 55%, far outperforming Nifty's 14% and Nifty Auto's 35% up move. Now, let's answer the question of why the stock has seen a big fall today. Answer to that is weak festive demand and margin pressure. So let's first address festive demand. Bajaj Auto in its interview with CNBC-TV18 has said two-wheeler industry has seen a growth in the range of 1 to 2% in the first half of the festive season. And this is against companies' expectation of 5 to 6% for entire festive season and brokerage's estimate of 8 to 10% growth. Another concern is related to margin. While Bajaj Auto has maintained its margin above 20% for the fourth straight quarter, this margin for second quarter, that is Q2 FY25, is below expectations. And company believes this margin is best in class in the industry and should be viewed in the context of the growing EV portfolio, which now constitutes 20% of domestic revenue. But the concern for market is electric two-wheelers on a standalone basis remains margin dilutive. Third reason of today's fall can be attributed to rich valuations. In the last 2 years, auto stocks in line with market have seen a huge surge in its valuations. Bajaj Auto, for example, is currently trading at 28 times FY26 PE against 5-year average of 20 times. M&M trades at 26 times versus 17 times. Hero MotoCorp at 20 times versus 18 times historical average. Now the key questions are, Is this festive demand slowdown only a temporary blip? And will we see a recovery in the second half of the festive season? Market will be tracking it very closely.
Thank you very much for that. But Sudarshan, I think in the EV business, they turn EBITDA neutral this time?
So if you look at EV portfolio as a whole, that is electric two-wheelers and three-wheelers, then it has turned margin positive. But if you look at electric two-wheelers on a standalone basis, it remains margin dilutive.
Okay.
Thanks a lot, Sudarshan, for that. In terms of Bajaj Auto, I think the most profitable is the three-wheelers, then is the two-wheelers. And on the EV side of things as well, the three-wheelers continue to remain positive, while the problem is on the two-wheelers in the profitability aspect. So they're gaining market share there, but it appears they're still struggling on the margin front.
Deven Choksi is now with us on the show. Deven, what does one do with Bajaj Auto if one owns it? If one doesn't own it, is this a good opportunity to go out there and buy? Stock has fallen 12%.
Yeah, good afternoon, Hima. Well, I think the market has priced in significantly high amount of growth for most of the companies, including the auto companies like Bajaj Auto. And slightest of not meeting the targets could possibly result into this kind of sharp fall. So let one be prepared about that kind of a situation. However, as I see it, I think things do not change much for Bajaj Auto. In a particular quarter, even if I think the volume growth has not met the expectation, I believe that post-monsoon, the demand is expected to surge, and probably I think you are likely to come back to the normal rate of growth in the markets. And given the kind of possibility that the company is having with the range of vehicles that they have brought in, particularly the CNG vehicle, where the margin is absolutely expected to be higher and positive. Even in the electric three-wheeler space, where the company has turned profitable, I believe that I think these are some of the product portfolios could possibly also sustain the higher amount of growth in the rupee value terms. So from that perspective, one can definitely look forward to the company with positive mind. However, as I said, that everything is priced into the valuation today. Unless I think market gives time correction stroke price correction, I'm not seeing, I think, too many early run up, I think, in this kind of a company, even though I think the sales comes to a little normal level. So maybe it's a range-bound trade continuing for this company going forward.
All right, that's about Bajaj Auto. We'll discuss that in greater detail once more. But for now, let's talk about the city gas distribution companies. Now, sources tell CNBC-TV18 that APM gas allocation to city gas distributors has been cut, and it's cut sharply from 72%. It's now down to nearly 50%. Sonal joins in with the implications. Sonal.
City gas distribution stocks, they are in focus. Remember, these stocks are already down around 5 to 6% this week so far. Sources are now suggesting that the allocation to these companies in terms of APM gas or the domestic gas, it has been cut to around 50% versus the 70% levels that they were seeing earlier. GAIL has sent out a notice to all these companies indicating the cut that was effective from yesterday, that is 16th of October. The industry, however, will see some pressure because of this, on the back of which some of the private players have gone ahead, spoken to the government as well, asking for an increased allocation. Now remember, this is something which is a routine practice where the gas allocation changes, but this time around the cut has been sharper than what was expected. So the analysis suggests that yes, there could be some margin pressure, on the back of which these stocks have come under pressure as well. Remember, the APM allocation at the start of FY24 was around 85%. So cutting it to 50% is a very steep correction, and that's the reason why the stocks are sulking in trade. This would imply a hit of around 1.1 to 2.3 rupees per SCM on their margins, because now they will have to use imported gas or LNG, which is priced at around $11 per MMBTU versus the domestic gas price, which is capped at around $6.5 per MMBTU. This would mean that the companies will have to go ahead, they'll have to take price hikes, and the calculation suggests that it should be anywhere between 5 to 6 rupees per kg. If they do that, margins will be under control, margins will be at similar levels to what they were making earlier. However, conversation with industry experts and analysts suggests that because of the upcoming assembly elections, maybe it would limit the ability of city gas distribution companies to go ahead and pass on these price hikes to customers, thereby impacting their margins. And that's why Q3 could see margin pressure for these companies. And that's why this is something which is impacting all the city gas distribution stocks today.
Thanks a lot, Sonal, for putting that into perspective. So they get lesser amount of allocation, then in fact when the input cost goes up, and if they go ahead and take prices, which is a big if, then their volumes go to get hit. So irrespective, it appears their profitability could come under pressure. Devin, what's your view on these companies? All of them under pressure, and they've already seen a bit of a cut in the run-up to today's news itself.
Yeah, Nigel, I believe that I think these kind of companies are always dependent on the government policy and their decisions. Someday I think it affects the supply, someday it affects the pricing. And as a result of which, I think the vulnerability in the movement of the stock price is something which is most unpredictable. To me, I think we basically don't have much exposure into this particular space, largely because of this reason which I explained. At this point of time, I think given the number calculation that one is seeing, around 2.5 to 3 rupees per kg kind of a cost increase is not ruled out, provided I think they are buying from the spot market and possibly supply the requirement which the customer is asking for. Most likely the price gets passed over to the customer in most situations. So to an extent, I think the impact should not be very negative on the books of the company. But I think if some percentage of the price passover is not taking place, definitely I think it's not a good sign. But nonetheless, I think the stocks are not likely to get rated well at this point of time. So stay out, I think, as far as the call is concerned on the investment.
All right, Devin, the markets were moving to the low point of the day, but Orient Cement, between yesterday and today, the stock is up 15%. I'll tell you what, in the last 5 months, numerous times, various people have told me this is done. It's a done deal, and it seemed like a done deal, and there were reports that suggested as well, though the management maintains that no, there is, they are not in talks with any player. In 2 days, don't pull up the 6-month chart, it's up 70%, yes, but the stock went closer to 380 rupees and then it pulled back to 280. What's your view on the stock? It's at around 340. In 2 sessions, the stock is up close to around 15%.
It's more of a trader's call. I don't think much of an investment idea that we can talk into this kind of news-driven activities. To me, I think cement as a sector as a whole, I think definitely in the second half of the year, we are likely to see the higher amount of offtake. And at the same time, I think the larger players who have the ability to supply, I think the bulk segment, maybe I think are going to be beneficiary. Whether we are going to see the price increase in the cement, I'm not too sure. But whether the cost will remain under control, the answer is yes. So to an extent, I think it's more of a play for the larger player. And maybe smaller companies like the one which we are talking about, I believe that I think it's driven more on the news. So no call on the investment side as far as this company is concerned.
All right. And, Devin, I've made a couple of calls earlier, and I believe that not talking about this asset, but before the end of this fiscal, there could be a couple of more assets that do get folded into. By the way, we have Tata Communications. Those numbers are flashing for you on the screen. The net profit is up marginally, close to around 3%, but I think we're waiting for the other set of numbers as well on Tata Communications. For the time being, the stock has moved to the low point of the day.
On a quarter-on-quarter basis, profits are down nearly 32%.
Oh.
So year-on-year, it's up 2.87, about 3% on a year-on-year basis. But quarter-on-quarter, there is a drop in the company's profitability, and quite significantly, close to about 30%. The stock has also corrected from its peak that it hit in the beginning of October, and in the last 6 months, as you can see, it's not given any return. The stock has been absolutely flat, down 1%. Awaiting more numbers now.
Okay, all right. So we'll get back to analysis on that. But the stock that we mentioned earlier today, the start of the trading session was Nalco, and we said it could relatively outperform. Let's run you through details on why exactly was that call. First, Alcoa, they came out with a set of numbers overnight, and after hours trading, the stock was up more than 5%. The reason that the stock was up is because the numbers look quite good, and they attributed it to 2 factors: lower costs and higher alumina prices. And their commentary on the alumina market is something that that investors have read through very, very positively for Nalco, because they said that they expect the alumina supply to remain tight for the next 6 to around 9 months. And that's what's depicted even if you look at the aluminium realizations. Just in the previous quarter, it was around $400 per ton. And now it's moved close to around $500 per ton. And at current spot, it is more than $600 per ton. So if you just pull up those pricing, that will tell you the way that alumina prices have moved very, very strong. What's the problem then? Why are alumina prices moving in this manner? because there are production disruptions at various parts of the globe at refineries. There's some maintenance activity going on. There's also lack of domestic bauxite in China, which is causing bauxite prices to move up, which is in turn pushing up alumina prices as well. Remember Rio Tinto earlier this year, they went ahead and they cut their alumina production guidance for this year itself. So both, you have a deficit in alumina production because of these shutdowns, and bauxite is in short supply. Nalco, that's the pure play with regard to alumina. And the Nalco management has joined us here on CNBC-TV18, and they gave us their take on both the factors. One is on prices. They said that prices should be at around $600 per ton. And also, if you look at alumina prices as a percentage of aluminium, it's at around 23%. But the Nalco management believes, yes, it should hold at these levels because of the deficit that's prevailing in the market. On an average, normally you see alumina as a percentage of aluminium at around 15 to 17%, but that number has moved up to around 23%. On the production aspect, they're saying that this year they'll do 2.1 million tons, and because the alumina refinery will come on stream, gradually it will increase by 500,000 ton odd. Put everything together, MK, they have come out with a note earlier this week, and they said that a company, that's Nalco, that did 3,000 crores of EBITDA last year, they're saying because of the higher alumina prices, aluminium prices as well are holding steady, and they have expansion coming on stream. They expect that the EBITDA number could double to more than 6,000 crores odd. So put all this together, Nalco is the one that's outperforming the market as well as the metal index itself. Devin, your take on Nalco. The problem is the PSU, but maybe the street is discounting this momentum that it's got with it with regard to the alumina prices.
So as it stands, I think from the global market perspective, I think the demand scenario remains upbeat, and I think the cost scenario remains subdued. So that is adding to this particular commodity, I think, in the current year. Even if you look at Alcoa's guidance, which they have given, I think they are pretty upbeat about the guidance, and they are talking about some decent improvement over next 2 quarters in the earnings. So should that be the case, then probably I think the commodity prices will probably fetch better realization and profit for the companies. But I'm not too sure about Nalco, since I think we don't have the coverage. Not too sure about how much earning impact it could have on the books as far as the company is concerned.
Okay, Havells Q2 numbers up for you on your screen. The company's top line has grown by 16.4%, ahead of the CNBC-TV18 poll of 11%, but it is a sharp margin contraction. EBITDA margin at 8.2% is down 140 basis points on a year-on-year basis, and it misses the CNBC-TV18 poll by more than 200 basis points. So a sharp miss on the company's profitability. That's the reason why the stock has tanked close to about 5% post the numbers, and it's driving a miss on the company's profit number too. So the profit growth too has come in much lower than what the street was anticipating. So the miss has come in on the margin front, even as the top line continues to remain very, very strong. In fact, stronger than what the street was anticipating. I don't see any, management, statement in, at least the numbers that have been released so far. To get a sense of what happened in terms of the margin performance this time and what the festive season outlook is. Devin, comment on Havells?
I guess I think the reality checking is taking place now. Most of the companies which have been reporting higher growth rate, now they're getting moderated, also because of the fact that I think they are on a higher base. Last year to this year, I think the base has increased, and as a result of which, any growth in the working of the company is not going to be the same as it was, I think, in the earlier period. So that is one important aspect where probably I think the growth rate will be seen tapered off. 11.5-12% nominal GDP growth rate, on the top of it, I think if the business of companies like Havells, which is growing, potentially show around 16-17% kind of a growth, is a decent growth. If anything over and above that growth, when it happens, I think it would be a bonus. But in my viewpoint, I think two factors are working against at this point of time. One, most of the companies are in a capex mode, expansion mode. Additional amount of cost is being incurred in building the operational side of the business. And as a result of which, I think the future revenue profit definitely will come. But at the same time, it will have some amount of impact on the margins, which is also what is being reflected in Havells numbers on the first cut basis. So certainly, I think we are not going to see the same level of growth in most of the FMEG companies as we talk about in coming period. Maybe some amount of subduedness will be expected. Would be some better performance, I think, in the second half. But at this point of time, for the second quarter, definitely, I think the performance remains slightly subdued. That's what we expect.
Actually, pull up Polycab as well, because Polycab will report numbers shortly. Stock was up a little bit, I mean, not much, but it was up for what it's worth. That has also given up gains quite sharply from the day's high. It's come off. The high was 7319. It's at about 7170 on Polycab. There you go. And I think after the Havells numbers, it's also come off just a tad bit. So that's the indication from Havells at this point in time. By the way, KEI was the other one, right, which reported numbers. You got Havells, and now I think you'll get Polycab shortly in the next hour or so as well. Devin, we'll thank you here. Thank you for joining us. Appreciate it. Pathik Gandotra of Drone Capital Advisors on the other side. Stay with us. We continue the market conversation. Welcome back. Markets down 220 points. We're at about 24,750. We have Pathik Gandotra joining us, partner of Drone Capital Advisors. Pathik, good afternoon. Good to have you back on the program. That Bollywood dialogue which you usually use, right? Topi Sambhalo. Is it Topi Sambhalo time, or Is this temporary?
No, it's just that you just gotta stay put and wait. गाड़ी बैंगलोर तक रुक के जाएगी.
So what is going on? What's the primary driver for this weakness, in your opinion?
I think the earnings season was expected to be lackluster, I guess, and I guess it is being proved to be that. There are other factors like the China weightage going up, which has led to FI selling, and all those factors which are impacting the larger caps. And among the mid caps, I guess the valuations have become a bit stretched. So there's a time for a pause. I mean, it's not as though the rally can continue unfettered, given the fact that a lot of the earnings growth has been very spectacular in the mid cap space in the past 2-3 years. So I guess the market is just taking a pause till the earnings catch up. All the earnings in every sector may not be the same. I think it's time to now pick. It'll be more difficult to make returns from here on. And so bottom-up investing, I guess, should do well if you're invested in long-term growth stories. So we remain pretty much invested. We've taken some chips off the table, but largely we are invested.
Sorry, where have you booked profits? And if you could give some indication of the bottom-up ideas, even if you can't name the stocks, but tell us the themes. What is the driving force behind, liking the individual stocks? What's the trend?
So I'm saying we book profits across the board in stocks which have become a bit overvalued for some time. But I mean those are just tactical profit bookings. In correction, we'll buy back again. I mean, we are invested in a whole host of ideas in the EMS space, in the building material space, in garment exports. These are a few of our big themes. We've not yet taken up a big position in IT, but we might look at some smaller companies as we get more clarity on earnings. The earnings is, for example, in the IT space are clearly showing that they have bottomed out and they've stabilized. Now from here on, I guess there will be something which will do well. Sorry.
Yeah, Pratik, please go ahead.
Can you hear me?
Yes, we can hear you. IT earnings have bottomed out, so you know that sector could look up. Please go ahead.
Yeah, so that sector will, I think, look up. So we look for good bottom-up ideas in that space as well. So that's one of our big themes which we are looking at. Next is also, the real estate sector has done extremely well for the past 2 years. So building material space is also a place where you might get some ideas. But the point is, everywhere valuations are stretched. Earnings have yet not come in all these spaces. Valuations are stretched. So I think the sideways correction might actually be a very good idea. I mean, it might just help bottom-up investors like us.
Hi Pratik, good afternoon. Nigel on this side. So we're having a bit of a subdued Q2 earnings. But would you be optimistic that we see a recovery in the second half of the year, and then for the year we do pretty okay on the earnings parameter, because that's the one that will drive the markets ultimately?
Yeah, I guess so. I think earnings should revive across the board in the second half. I think in the first half, the first quarter got a bit washed out because of the elections in a lot of sectors, and companies are still recovering, getting the distribution in place. So I think they're still recovering from that, the aftermath of that. But I guess the budget and the fact that there's a stable government and the government is spending aggressively will work through earnings in the next in the 18 to 24 months. So I think our outlook for earnings is pretty strong. It's just that valuations have gone a bit ahead in most sectors, but earnings should actually revive. So, for example, like we are saying in the IT space, earnings will revive. I think we'll do better as in successive quarters. Actually, all export-facing sectors, because if you see, the US economy is holding on pretty okay. It's not really gone through a deep recession, despite the huge interest rate hikes and the liquidity tightening that the Fed has done. The economy has held up pretty well, and now the Fed is back to cutting rates because inflation has fallen. So I think the impact of both falling interest rates and a stable economy, it's a kind of a Goldilocks scenario that's happening there. And so if that works through, then you might have export-facing sectors doing extremely well, which is where our theme of technology and textile exports and in any other sector, I mean, which is big on exports, I think we'll do pretty well.
I think Gokuldas exports has been a big bet for you for a while, garment exports when you're talking about. But I think, although I'll just tell you, there was a note from Bernstein and it was interesting. They said, well, the thesis basically was when you're coming off a pretty euphoric phase, looking at consensus earnings forecasts is of limited use because, you're not able to correctly predict what earnings will be 15% or could actually slow down to 10% because you're coming off this strong momentum in a very euphoric phase. That was their contention. And increasingly at the margin, one is starting to, many are quoting a lot of the high frequency publicly available data and saying maybe there's a bit of a cyclical slowdown, which is underway. I was mentioning earlier Nomura, Morgan, I think I quoted Bernstein earlier. Do you think perhaps we are in one, a slightly softish patch?
I think you are coming towards the end of it because the data has been soft for 6 to 8 months already. You can see based on the elections and all that, as I've just said some time back. I think as the government spending continues, if again revives, I mean it's also taken a bit of a hit. So once it revives, I think the cyclical slowdown will be very, very short-lived. Also, the fact that interest rate cuts are around the corner and then they'll work their way through. So I don't know whether it'll take 1 quarter, 2 quarters, but I think you are you are past the hump. So I think from here on, things should look up. I mean, you might have a very good festive season, is what we expect. The rains the monsoon has been pretty decent, and that will also work through farm income. There's also the fact that the government has done pretty lot of schemes, I mean, across the board to boost rural income. So I think if you look at all that, the income part of is getting stronger, and so I think earnings should logically revive.
I just one more thing, and this is slightly stock specific, but I just want your thinking, not whether you're buying or selling. So Sula is something that you liked at one point, right? Now alcoholic beverages are doing well, and the case for Sula has been, I think, it's well known, wine penetration and very low levels, and eventually it should. The stock's not performed at all. I just wanted your thinking around this. Is it a matter of time, or you think there's something amiss?
So I wouldn't like to comment too much on company, but since you're asking, the point is, I think the growth has been a tad slower than what was expected. I think the management might be needing a bit more aggression on expanding their distribution because it's a very good franchise. It's amongst the dominant franchises in wines today. The big theme of wine consumption in India is secular. So I don't think that theme changes. So I think it just requires a bit more aggression to the management to increase distribution rapidly. I guess that's where the problem might be. That's why the growth is not as strong as one would have thought. Otherwise, if you see, all the building blocks of growth are in place. So I think an aggressive distribution strategy might do them well.
You spoke about IT earnings acceleration, and that's a theme that you would look at. Now, in IT, what would you prefer? Would you prefer the large caps? Would you prefer large caps where there is earnings comfort or some management change? Mid caps with the BFSI exposure or these auto R&D companies? Where does your preference lie when it comes to IT?
So I'm saying that I'm not sure what space you'll eventually look at. I'm saying that there'll be a broad-based acceleration in IT earnings, and we look for our spaces. We look for stocks which are beaten down where there's strong earnings growth potential. So I really don't have an answer to that question. What specific sector portion of that space will I look at? But normally we look at young companies, we look at new companies. I mean, that's where our alpha comes from. And so we would look at spaces like that. They might be a bit expensive, but that's a space which we prefer. We prefer companies with very, very strong growth rates. So what's happening is that a company with a very strong growth rate may not have got the multiple that it deserves because of the overall IT suppression in multiples and earnings. So once we can bet on that and across the board expansion, earnings and multiples for IT, and so some strong growth story might come our way. I don't have a direct answer to your question.
All right.
No, you don't have a company in mind, or you don't want? I mean, just
no.
You don't have that.
Actually, I don't have a company in mind. I'm saying that's a space. The question
it's a space to look into.
Yes. The question you put to me was where will you look into for new ideas? So I said I'll look into the IT space for new ideas.
All right, the sector of the day, Pratik, today has the two-wheeler space. Bajaj Auto's numbers, it missed what the street was working with. The commentary the street didn't like too much. And the problem is that valuation-wise, it's trading at a big premium in comparison to its 5-year average. What do you make of the two-wheeler players? Anything looks exciting enough for you out there, or do you think it's run its course?
I think two-wheeler space is going through some sort of a disruption, right? Because of the EV boom. Ola is coming through. It's taken huge market share. And so at least on the top line, that obviously has an impact on all the two-wheeler players. I think that's the story which is playing through. So I think the company, I think that's what is the big reason behind, maybe one of the big reasons behind the earnings, behind the top line miss in Bajaj Auto. And obviously stocks have gone up. Across the board, everything has gone up. There's just too much of liquidity in the market. There is still too much of liquidity in the markets. So if you recall, 6 months back, the thing was mid caps have done well, large caps should do well. When we spoke last time, the Nifty was at its all-time high, and you told me that. It was your birthday, I guess.
That's correct.
Yeah. So at that time, it was just FI flows were coming through. And so that was, it was faceless money, and that was driving every stock up. So I think that must have been the reason for every stock to get minor related because of liquidity. I think earnings differentiation will happen. So the point I'm trying to make is that one has to look through a bottom-up kind of strategy and see which of the stocks has strong earnings. Nigel, we don't focus on large companies at all. Our space is a mid-cap space, so I'm less concerned about large companies.
All right, Pathik, we'll leave it there. Thank you for joining us. Have a good one. Appreciate your time here on CNBC-TV18. Thank you. All right, well, that's Pathik Gandotra at Drone Capital. We'll take a break. We're going to come back Okay, I think what we'll do is we'll just look at numbers. We've been talking about numbers that have come through, but two big numbers from the IT space today. Infi will report and Wipro will report as well. Rima,
three big numbers. LTI Mindtree too, and that's also now a Nifty company. So let's talk about Infosys. Yeah. Now here, very strong growth expected for the second consecutive quarter. The street is working with a 3.5% kind of top line growth ahead of what peers have reported. Just to recap, TCS and HCL Tech growth was 1.5% in the quarter gone by, and in Q2, and for TCS we're expecting about 3%. Will this drive a guidance upgrade, or will they wait one more quarter to see how the second half of the year is panning? I mean, the situation is panning out. Most on the street believe there is a case for a guidance upgrade. But that said, the stock has done very well since June. Since June, Infi has outperformed most of its larger peers with a 40% up move. Now for Wipro. Now Wipro has gone through 6 consecutive quarters of a revenue decline. Now this quarter, will they spring a positive growth? Our expectation is it should be flat, but with a positive bias. So that's key to watch. Secondly, the Q3 guidance, that's the December quarter guidance where we typically have furloughs. Will they give a positive guide? According to consensus, it's largely seen between minus 0.5 to 1.5%. And plus this time there is going to be that bonus issue that the board will consider. Now, when it comes to LTI Mindtree, the optimism for LTI Mindtree stems from their BFSI portfolio, which is 35% of their overall revenue. And in BFSI, we are seeing positive momentum. So LTI Mindtree is also likely to report a strong quarter. Again, second consecutive quarter of strong growth. We're expecting a 2.7% top line growth, margin expansion of 50 basis points. But here for LTI Mindtree, the street will watch how do they get back to industry leading growth that they used to report till about a year back. So that wraps up in a nutshell on what the 3 big IT companies are likely to report and what the street is watching. But Axis Bank will be reporting numbers later in the evening. Vamakshi joins in with the key expectations. Vamakshi.
Well, Rima, Axis Bank is expected to report a decent set of numbers. Net interest income is expected to come in at 13,620 crores. This is an uptick of almost 10.6% is what we're expecting. The net profit is expected to come in at 6,300 crores. Again, an uptick of almost 7.4% is what we're expecting out here. When we talk about brokerages and their key expectations, Kotak is building in a loan growth of around 11% YOY and 2% sequentially. They're expecting the net interest margin to be more or less stable quarter on quarter as they believe that we are past the phase of repricing of funds. So therefore, they're expecting NIMs to come around 3.8% for the company. Fee income growth, in their opinion, could be sluggish, reflecting weak loan growth. They're expecting slippages of around 5,000 crores, which would account for nearly 2% of the loans. And this slippage, would be largely led by the retail segment. Bernstein, on the other hand, said that credit costs could see significant moderation from the levels that we saw in the first quarter of this year. As far as some of the important things that we will be watching out for in the numbers will be the credit cost. That will be very important to monitor, because if you recall, in the first quarter, the higher credit costs were the key highlight for the numbers. In fact, the credit costs were so high that they in fact overshadowed most of the positives that came in the first quarter numbers. Apart from that, deposit mobilization as well as NIM trajectory will be something that we will be watching out for. Overall, it's a decent set that we're expecting from from Axis Bank.
All right, thanks a lot for that, Vamakshi. Well, the stock price moved today. The stock is down close to 2%. Let's see if they deliver, or in fact, there is some weakness in the counter in today's session. For the time being, let's take a short break. As always, we'll get you buy-sell trades from our technical expert on the other side.
Welcome back. Let's get in the handle for a few last trades. About 15 minutes left to wrap up what's been a very weak trading session. We're about 300 points down on 200 points, sorry, down on the Nifty right now. Nearly 1% gone. Mitesh is with us for a few BTST calls. Mitesh.
So you can actually say it feels like 300 points down, the way the market has kind of fallen and not recovering at all. I have a STBT on Tata Steel with a stop at 154.5. Here I would look for a target of around 148, 149 for tomorrow. And Titan is a STBT as well with a stop at 34.10 for targets of 33.60.
Okay, let's get to some macro data. Now, with most of Q2 data, like export, import, IIP, PMI, GST, analysts have begun downgrading the Q2 GDP growth forecast. Now, CNBC-TV18 poll indicated that 60% of the economists have cut their growth forecast in the past few weeks. Lata is now joining in. She's done this poll and she joins in with her editor's take. Lata.
Yes, now that most of the August-September data is in, and many of it were found to be soft, we decided to do a poll. And our poll indicated that 60% of the economists whom we had polled have cut their estimates, GDP estimates, for the second quarter. And the cut is between 10 and 40 basis points. So now the average second quarter GDP is coming in at 6.79%. Earlier, it had come in at 6.91%. Obviously, not everyone is at 6.79. The largest number of economists were at 6.8, but there were some who were lower. The Reserve Bank's own forecast is 7% for the second quarter, which they announced in the October policy. But in the August policy, they had 7.2. So they've already brought it down by 20 basis points. For the full year, there were fewer respondents, but there as well, the average has come down in the past month to 6.85% from an earlier average of 6.91%. 20% of the analysts polled have brought down their forecast for the full year, but another 30% said that there is a downside risk to their forecast, but they have not changed it. The reasons for the slowdown, which people mentioned: one, the September imports have clearly remained flat year on year and have fallen by about 15% month on month from August to September. That is the immediate reason. The export data from September to September has remained flat. August IIP was minus 0.1%. August core sector was minus 1.8%. The September PMI came in at an 8-month low, but it was high at 56 plus. And the September GST collections came in at only 6% compared to a nominal GDP growth of 10 to 11%. That is low. It's also the lowest, probably the lowest growth since COVID. Now, the earnings data also forecasts show that it is going to be a muted quarter. Motilal Oswal says that the Q2 nifty earnings growth will be only 2% and that the margin tailwinds are also declining. This impacts the GVA, and MK also says that the Q2 nifty EPS is likely to grow at only 5%. Put all this together and you can see why economists are lowering their Q2 GDP growth forecasts.
Got it. Thanks a lot for that, Lata. Well, for the time being, we slip into a short break. We come back, final 10 minutes of trade. We'll get you some more market talk. Well, 5 minutes to the close of trade, and the stop loss today comes in at around 3:30 p.m. It seems, at least for today. Amrish Balika is with us. Hi, Amrish. Havells numbers, they are the latest casualty. Today, quite a few earnings disappointments is what we got. Bajaj Auto, no signs of recovery all through the trading session. And now Havells, the stock is down close to around 7.5%. It's a large cap name. Your view on the stock?
I think the sort of earnings which is coming clearly is disappointing the markets because at the level the markets are, clearly you require super earnings to keep that momentum on. And what we are seeing is the reverse. In fact, whatever we saw in Q1, I think Q2 is, at least as of now, seems worse than what we have seen in Q1. So with this slowdown, clearly we'll have most of these stocks correcting because, I think they had become multi-baggers in the last 2 to 3 years. So it's quite natural that we will see decent correction wherever the earnings fall short. And I think that's what has happened with Havells.
Okay.
By the way, Europe is trading with strength. It's up about 0.5 to 1%. The CAC, DAX and the FTSE. Today is the European Central Bank meeting, and they're widely expected to deliver their third interest rate cut. So just pull up that's CAC for you. That's up nearly 1%, but the DAX is up by a little more than 0.5%. You were saying? Well,
that's right. Well, we'll keep an eye out on that. Amrish, normally when you join us, you give us a stock that you're tracking. Which one is it this time?
Today's pick is Bata. It's the largest retailer and leading manufacturer of footwear in India across segments, which is men's, women's, and kids. 3 years back, they got into the sneaker segment, targeting the millennials. And this is a huge segment, and now they have 739 sneaker studios across the country. Distribution network is super, about 50 towns covered through 2,089 retail stores. And they're expanding into Tier 3, Tier 4 through the franchisee route. And every quarter, they are adding about 40 to 50 exclusive brand outlets. And e-commerce also is witnessing super growth. We have seen that over the last 1.5 to 2 years. However, overall, FY24 earnings was flat. Q1 FY25 earnings also disappointed. So because of which we have seen the stock underperform in a good market. But looking at the balance sheet, which is very healthy, decent cash on the books, negative working capital cycle, and input costs also have been rationalized. So margins are expected to improve. And the management has been upbeat on its prospects in the recent investor con call. So for FY27, my expectation for EPS is about 38. And this should result in a target price of 1,900.
No, absolutely. Bata is Ambarish's pick today. Ambarish, PSU banks, right, which have reported numbers so far, not a bad look. Bank of Maharashtra, I saw Indian Overseas Bank, and I think there was one more. Of course, the biggies are yet to report.
Exactly.
But numbers have been decent. Any thoughts here?
These numbers have been decent, and among them, surely I would still look at Bank of Maharashtra. And we've seen Bank of Maharashtra, in fact, correct in the last, 2 to 3 months. And I think at the current levels, looking at the earnings, I think there should be a decent upside. In fact, the upside, like I'm talking of, is closer to about 74, 75. But then it could take possibly 6 to 8 months from here. As far as the other PSU banks, especially the larger ones, which should come, I think the NIMs, we should see a drop, at least a marginal drop. And as far as the loan book is concerned, especially the retail loan book, I think we should see some amount of issues there. So I think that could be one of the reasons why we could see underperformance going ahead, especially from the larger PSU banks.
Got it. All right. We had the numbers of Jindal Stainless as well that were flashing on the screen. Top line, more or less flattish. And the EBITDA number was ballpark close to 1,200 crores. I think that was a broad estimate that Nuvama had put out as well. Stock has seen a bit of a downtake, but I think in the last 18 months, it's moved from around 200 rupees to around 750 rupees. Amrish, any view on JSL Stainless? It's the only pure stainless steel player, and some on the street would argue that it's actually a converter because it's getting its nickel and then, in fact, converting it into stainless. And stainless steel usage itself would go up drastically here in India as well as in different parts of the world. Your view?
Yeah, Nigel, but I don't track this closely, so a bit difficult to really comment on it.
All right. Anything you like from the metals pack? What stands out today is Nalco, if you have a view on that one.
In fact, Nalco, I've been positive, and the other one is Tata Steel. I mean, if we see some correction there, I think one should look at buying into Tata Steel. Clearly, I'm looking at it from the China recovery point of view, and with that, we should see most of the metal like stocks doing well. So Tata Steel would be my pick, where in fact I have a target price of about 210. Again, this is long term, about 9 to 12 months.
Okay, counting down to the close, we're ending with a cut of more than 200 points on the Nifty. The Nifty ending pat at 24,750, virtually at the day's low. The mid-cap index struggled more. The mid-cap index seeing a brutal fall of more than 1,000 points, down 1.7%. In terms of the big sectoral losers, auto right on top, 3.5%, but realty was bruised in trade. Banks underperformed. You had FMCG under pressure. The only space where there was buying today was IT. The Nifty IT index up 1.5%, with Infy Tech Mahindra leading with gains of about 2.5%, closer to 3%. Even Emphasis by the end of trade up nearly 5.5%. But on the way down, Bajaj Auto deserves mention, 13%, the biggest single-day loss since the COVID fall. That's down, and Nestle too, 3.5% gone on the back of subdued margin performance and a weak top-line growth.
Absolutely, and it's been tough today. Just look at a few other names in the broader market which were lower. So BSC sharp cut once again. It should come up on your screen. So recent high was not quite 5,000, but almost there. Stocks at about 42.60 today. KEI Industries continues to dip as we sort of close this session out. Actually, look at Polycab as well. Polycab, when we started at 230, had 0.5% gain, ends 2% lower. Reports numbers, I think should report numbers shortly. So maybe some positioning into the earnings. Havells, of course, reported numbers in the last hour. Stock ends sharply down, 8% Havells. So that was a big cut. BHEL was a sharp loser today. Oberoi Realty, actually the real estate index itself was a top loser, with some 3% cut, actually more, almost 3.5% cut. Tata Communication again reported numbers were subdued. That lost quite a bit. So from the highs. Pyramid Enterprises, Jyoti Structures, Newland Laboratories had run up some 15% in 2 days quickly, but that gave back some gains. And Goldium, which is the artificial diamond play, that also, by the way, lost after having a pretty large run. I mean, I think that's the context for many of these that we've seen outsized gains come through very quickly and some profit booking coming in today. So 0.9% loss on the Nifty, 24,750 is where we finally close the day out at. Well, it's a wrap from all of us here on Closing Bell. Thank you very much for staying with us, but just don't go anywhere. I'll take you through markets forward on the other side. Stay tuned.